Well, hello everyone. It's Jon Edwards from Edwards Wealth Management. And today we're diving into a crucial aspect of investing, how to measure risk in your retirement portfolio. Understanding risk is key to making informed investment decisions and pursuing your financial goals. So let's get started. Now, first, let's define what we mean when we say portfolio risk. In the most simplest terms, portfolio risk refers to the potential for losing money in your investments due to various factors like market volatility, economic changes, or company performance. Measuring this risk will help you to understand how much uncertainty there is in your investment returns. There's all kinds of different types of risks that you need to consider when investing. Number one, we've got the market risk. This is just the risk that the market goes up and down due to fluctuations that you can't control in the market. Number two is credit risk. That's the risk that a bond issuer is going to default on you on their payments. Number three is interest rate risk, and that's the risk that changes in interest rates are going to affect bond prices or other investments you hold. Number four, inflation risk, the risk that inflation is going to erode your purchasing power. Number five is liquidity risk. This is just the risk of not being able to get out of something and sell it quickly for a fair value. Ultimately, it's possible to lose money, and primarily we measure risk with volatility. And that tells us how much something goes up and down, basically. But, here at Edwards Wealth Management, we try to take a very scientific approach, and we use software to measure how much risk is in your portfolio. And we have some very powerful tools to help you analyze and understand whatever risks could be associated with your investments. Here's our step-by-step guide on how we do this for our clients. Number one, the first thing we do is get a risk assessment, a comprehensive risk assessment. You put into your portfolio details, and we get a real clear picture of the overall risk level. Our platform uses sophisticated algorithms to analyze factors like asset allocation, diversification, and different market conditions. Number two, one of the other things we like to do is stress test your portfolio. We can simulate various market scenarios to see how your portfolio would perform under different conditions. We can run scenarios like a major market drop, a period of high inflation. We can see how you would fare if your Social Security check gets cut as well. So this will really help you to understand what your potential risks and losses could be in an adverse situation. Number three, we use risk metrics. So our software provides detailed risk metrics such as standard deviation and beta. And these metrics give you quantitative measures so you can measure exactly how much is inherent in your own portfolio. Number four is the risk return analysis. So whenever you're taking a certain amount of risk, you want to be compensated with an adequate return. And our platform offers tools that'll help analyze whether a risk return is good or not, and whether it justifies the risk that you're taking. This is really crucial for people that are trying to make informed decisions about asset allocation. Another important thing that we need to do is get a personal risk score for you as a person in addition to your portfolio. So we will do a risk tolerance questionnaire, and we'll compare how the portfolio looks versus you as a person. And if these two numbers, these two scores don't match up, I mean, they don't need to be an exact match, but they should be somewhat close. But if there's a big gap, then we should certainly have a conversation and see what changes ought to be made. The risk score, it primarily just measures volatility. So it looks at the securities, and it tells us how much they bounce up and down on average in any period of time. And once we've assessed your portfolio risks, it's important to really interpret the results correctly. So number one is standard deviation. This is a common metric that's used in statistical analysis, and all it measures is the volatility of your portfolio returns. The higher the standard deviation, the higher the risk. Beta is more of a finance-oriented metric, and it measures your portfolio sensitivity to market movements. If the beta on a portfolio is greater than 1, that means that your portfolio is more volatile than the market as a whole, while a beta of less than 1 means it's less volatile. Understanding these two metrics, it can really help us to make informed decisions about your investments and align your portfolio with your personal risk tolerance and your financial goals. Based on your risk assessment, we need to make some adjustments to your portfolio. But here are some good tips if you do find that you are taking on more risk than you thought you had. Number one, diversify. Take advantage of that free lunch and spread your investments out across multiple asset classes, sectors, or geographies. This is time tested and it definitely reduces volatility and risk. Number two, rebalance. As the year goes on, your stocks might go up, your bonds might go down, and you need to rebalance them back to where they started the year. So regularly review and adjust your portfolio to maintain that desired asset allocation. Number three, consider risk-adjusted returns. Focus on investments that offer a good balance of risk and return, not just return that comes with high risk necessarily. You want to get compensated adequately for whatever risk we decide to take. Number four, use an investment product that has some sort of downside protection. Incorporate products that offer downside protection for part of your equity exposure. I think that can make a lot of sense, and it'll help to mitigate losses when the market does have a downturn. Number five, consider using a guaranteed fixed annuity. Lock in a great rate without the uncertainty and fees of bond funds, and by using a guaranteed fixed annuity. It's a straightforward product. Number six, use CDs that are tied to the stock market. Where appropriate, there are CDs that are tied to the stock market that can benefit from the potential market gains while protecting your principal with FDIC insurance. Number seven, stay informed. Keep up with the market trends, the economic news, and be proactive to making adjustments in your portfolio. Well, that's it for today. I hope you enjoyed the video, and thanks for watching. If you're curious about how the risk in your portfolio might compare to your personal risk tolerance, just click the link in the description, set up your complimentary strategy call, and we'll be happy to crunch the numbers for you and see if we can help out.